So I'm going to be talking about investing during inflationary times. Last month, in February 2022, inflation hit 7.9%. That's high, but it was double that in the early 80s and over 20% during World War I. We've become accustomed to decades of low inflation. So people that haven't been through inflationary periods might think it's the end of the world, but this isn't the first time it's happened. Those of you who were around during the late 60s and 70s might have remembered a period of prolonged inflation that really affected the economy. Stocks were basically flat the entire decade. There was no growth, and it didn't end until Paul Volcker, the chairman of the Federal Reserve at the time, raised interest rates to 20% in the early 80s, when inflation was about 14%. What this did was reduce the supply of money and credit, which helped kill inflation. It also killed the economy and sent us into a recession, but as with every recession, we recovered and stock prices went higher. Inflation is currently almost 8%, but interest rates are only around 0.5%. So unless they go up dramatically, inflation may be around for a while and your money will continue to lose value over time. This is why it's so important to invest. When you invest, your money will keep up with or even outpace inflation. So let's look at some of the more stable asset classes that don't drop during inflationary times and can potentially outpace it. First, we have real estate. Now, I want to clear up a misconception many people have about real estate. You may have heard renting is throwing your money away. When you own a home, part of your mortgage goes towards building equity, which you aren't doing when you rent. But that's not necessarily true that renting is throwing your money away. Renting or buying should be looked at through the financial lens of which one will end up costing you less over time. Many people also consider the emotional aspect, like wanting a place to call their own or having somewhere their kids can grow up. But from purely a financial perspective, rent can often be better than buying, depending on where you are and how rents and mortgages are, how home prices are. Think about it this way. When you rent, the most you'll ever pay is rent. That's the maximum, right? But when you buy a house, the least you'll ever pay is the mortgage. Home ownership brings with it additional hidden costs many people don't even consider, such as property taxes, repairs, and a bunch of different things, right? You will never really own a home free and clear. Even after you pay off the mortgage, you still have to pay those property taxes. You'll still have repairs. You might have, lawsuits, something like that. So, and you don't have to do any of those things, the property taxes, the repairs, when you rent. So you will always have some kind of housing payment, no matter whether you rent or buy. That's why it's important to see which will cost you less over time. That being said, real estate is a pretty good hedge against inflation. It tends to keep up with and sometimes outpaces inflation over the long term. But in the short term, none of that matters because prices can double in 2 years, kind of like what it just did, or it can drop by half, by 50%, like it did in 2007. However, in the long term, people will always need a place to live. So owning rental real estate can be a stable investment. And owning a home can help you sidestep the nasty effects we're seeing in the rental market. Like over the last year, average rents have gone up by like 20% in 1 year. And I don't know a lot of people that got a 20% raise at their job this year. Owning a home means you're paying the same amount of mortgage to your lender year after year. So next we have gold, precious metals. So we have real estate, we have gold and precious metals. Gold is pretty stable. It tends to retain its value over time. Basically, if you take an item that can be purchased for an ounce of gold today, which is about $2,000, look back 100 years, you'd probably still be able to buy that same item with that ounce of gold. And I'm willing to bet in 100 years from now, that same ounce of gold will probably be able to buy that same item. The value remains stable over the long term, but over the short term, it can fluctuate. For example, over the last 20 years, gold has actually done very well. It's exceeded inflation. It's grown in value by an average of almost 10% a year, which is what you expect from stocks. So not shabby at all. But as time goes on, the growth will likely fall back down to the baseline of inflation. So here's another example to illustrate the retention of value you get with precious metals. Back in 1960, dimes were made of 90% silver, and gas cost around 30 cents a gallon, so you could buy a gallon of gas with 3 silver dimes. If you melted those coins down, you'd have about 1/5 of an ounce of silver, which at today's prices would be worth about $5, and you may recognize that as being the cost of a gallon of gas, current Russia-related uncertainty notwithstanding. So precious metals like gold tend to retain their value, and they can be a good asset to own for a conservative investor, someone looking for stability. So you can buy, back in the day, you could buy with those 3 silver dimes, you could buy a gallon of gas. And then today, again, you could buy that same gallon of gas with those same 3 silver dimes. Now, there's different ways of investing in precious metals. You can invest in the physical metal, or you can invest in companies that mine those metals, that mine gold. Owning gold is a good idea if you live in a place with hyperinflation or political or social instability. It allows you to maintain the value of your money. For example, if you were Jewish in Germany during the 1930s and 40s, they were being exterminated, they were escaping the country. It's easier to escape the country if you have physical gold because it's compact. It's very expensive, so you can carry a large amount of wealth in a relatively small item, right? So either in your pocket or in like a suitcase, right? It's easy to move, which isn't, the same can't be said if you own apartment buildings. For people like in war-torn countries like Ukraine or even Russia right now, the ruble is dropping like crazy in Russia. So it might be a good idea for Russians to put money into gold and some stronger currencies like dollars or euros. They won't really make any money, but the purchasing power is being maintained. And as for companies that mine gold, for example, it doesn't really matter what the value of the metal is if you are the one selling the tools to people, right? So back in like the mid 1800s, California had a gold rush. People came from all over to try to get rich, and many of them did, especially the ones who were able to hit the space first. Much like cryptocurrencies, the first people in the space became very rich, but the people that came later often ended up losing money. You know who didn't lose money? The people selling pickaxes and shovels, the tools needed to mine the gold. So investing in gold mining companies could potentially be a good idea because it doesn't matter what the price of gold does, they'll still make money selling, selling the gold to people or selling them the tools, right? So in general, investments that have kind of inflexible demand tend to make money no matter the economic situation. People will always need food, so you can probably expect companies that sell food to keep chugging along during rough economic times. Commodities are good too. Commodities are like wheat, beef, oil, iron, gold. Those are all commodities. Utilities is another one. People will always need electricity, gas, water, and internet, right? So investing in anything like that can potentially help reduce the effects of inflation. Companies like McDonald's and Coca-Cola, they tend to survive bad economic times because people will always need food. And if their inputs, their raw materials, the bread, meat, sugar, lettuce, if those go up in price, no big deal. They can just pass the costs along to the consumer and their profits won't suffer. It might in the short term, the price might fluctuate, but over time, they'll still be around. During inflationary times, value stocks tend to outperform growth stocks because growth, like for example, growth stocks, tech stocks, over the past decade or so, there's been a lot of cheap money, easy money, so they've been able to grow. They've been able to borrow to grow the business. But now that interest rates are going up, now that times aren't so good, they've been going down. So yeah, value stocks tend to outperform growth stocks during inflationary times, so they might be a good idea. Other good ideas might include TIPS, Treasury Inflation Protected Securities, which are just basically bonds, Treasury bonds that pay an interest rate slightly above the official rate of inflation. But since the government has an incentive to underreport inflation, TIPS may or may not keep up. Another idea is I-bonds, which are Treasury bonds that pay, currently I believe you can get about 7% for the 6-month I-bond, but the issue is that you're limited to about $10,000. So this doesn't really help people with like a larger portfolio. So does this mean you should sell everything you have and invest in these things that I just mentioned? No, I'm not saying that. But a good idea might be to diversify, to add some of these asset classes to your portfolio if you're heavily weighted in risky assets like stocks, especially if you're in the phase of your life where capital preservation is important to you, like if you're retired or you're close to it. This will keep your net worth from dropping too badly during the next crash. For the younger crowd, like those in the accumulation phase of life, those that are still working, they have a paycheck, they're saving a little bit of their money, they're investing it every paycheck. I'd probably stick to stocks, even with the current volatility, even with the stock market dropping, even with the risk that stocks are going to drop by 50%. because of this debt bubble that we have, right? But I'd probably stick to stocks if you're in your 20s, 30s, or even in your 40s. Maybe you can invest in like a total market index fund or an S&P 500 index fund. That way you're kind of diversified. You don't have all your money in one single company. Because every single company on a long enough timeline, every single company will disappear. You know, it's back during 100 years ago, the Dow Jones, I don't think there's a single company on the Dow Jones that was there 100 years ago. You know, so they all die. They all get acquired by other companies. But by owning the index, you get to have all those stocks. Like, for example, if you own the S&P 500 index, you own 500 of the strongest companies in America. And if, say, a company does poorly, it dies, like GE, for example. I don't know if it's been removed from the S&P 500 yet, but it used to be, it was on top of the world for decades, and recently it's just been bad. You know, so whenever a bad company falls below the threshold required to be a member of the S&P 500, it drops out and it gets replaced by an up-and-comer that will, you know, fresh blood. So by owning the index, you never really have to worry about picking individual stocks, and your money can grow with the economy because you're owning basically a piece of the whole economy. So these index funds, right, they can be very volatile in the short term because they are stocks, and you can lose half the value in a matter of months or in a couple of years. But over the decades, they've been proven to be one of the greatest wealth creators out there. And diversification basically is where you split your money up into different asset classes or different investments. For example, if you have all your money in Coca-Cola, you're not diversified. You would diversify by putting a little money in multiple stocks, like I mentioned, through the index fund. Or instead of having all your money in stocks, you might diversify by putting some of that money in other asset classes like gold or real estate. And this is what I'm talking about, right? You know, if you're close to retirement or if you want more stability, you can diversify your portfolio, maybe sell some of your stocks and buy one of these things: real estate, gold, tips, you know, even value stocks, whatever, commodities. Yeah, so it's just splitting the money up. So if one investment or one asset class drops, the others either maintain their value or they go up in value, which raise your overall portfolio, or at least helps it not drop so much as if you had all your money in the one stock or the one investment that went down. And diversification can really help your portfolio on the downside when the market crashes. Historically speaking, a retiree with 70% stocks and 30% bonds, drawing money at the safe withdrawal rate of 4% of their portfolio every year, has historically been able to survive pretty much every crash. And that's because when stocks drop, bonds tend to rise, though that's not always been the case, mind you. And the overall portfolio sees a much smaller loss than if they had been 100% in stocks. And again, gold or any of those other asset classes that I mentioned it can be added to your portfolio to help smooth the ups and downs. You won't go as your final balance won't be as high as if you had invested only in stocks, but you know, if you need stability, then that's something good. You know, what to invest in really depends on your risk tolerance and on your timeline. So, as I mentioned, stocks generally go up over time because they're part of the economy. You know, they're businesses, right? And when the economy is good, businesses make money. But they can have very long periods of underperformance. Between 1929 and 1932, which is this period right here, 1929 was when the market crashed. The biggest crash, I think it was in history, but this was when the Great Depression started. Between 1929 and 1932, the market lost almost 90% of its value. Imagine if you were a retiree, you retired on the day of the market crash in October of 1929. By 1932, it would have been worth about $100,000. You would have lost almost 90%. And you wouldn't have recovered that money. You know, you wouldn't have broken even again until 1954, when it would have taken 25 years to basically get your money back. So this can be scary if you're a stock investor and if you're like closer to retirement. But if you had left your money in there, and you had reinvested the dividends, because companies continued paying dividends during the Great Depression. So if you had that money you received from your stocks, if you had reinvested it in companies, it would only have taken 7 years to break even. And 7 years is a long time, but for somebody who's making 20, it's you have plenty of time to recover and get to retirement in good shape. Actually, a market crash is one of the best things young investors can hope for, because it means that stocks are on sale. You're getting more for your money than you would have gotten before the crash. So this is something to be welcomed if you're in the accumulation phase. You'd be getting 10 times as much for your money by investing at the bottom here in 1932 than you would have at the top. This is another example of the time stocks didn't go anywhere. If you invested $1,000 into large US stocks, so basically the S&P 500, at the beginning of 1966, by September 1974, it would have been worth less than $580 after inflation. You wouldn't have stayed in the black after inflation. Basically, you wouldn't have broke even until the end of 1982. That's like 16 years to break even, and that's scary, but much less scary when you consider reinvested dividends, and even better for those who consistently bought more during this time. It would only have taken a few years to recover, to go back up and break even with those reinvested dividends. So this is what the stock market looked like, the S&P 500, between 1928 and 2022, anyway, between 2022, adjusted for inflation. So this also doesn't include reinvested dividends. It would be a lot higher if those were included. So not a bad deal for someone with a long investing timeline. The stock market tends to be considered a proxy for the economy, and the economy tends to grow because the population will always grow. Well, not always, but the population tends to grow, and more people will want more goods and more services. And people now also consume more than in decades past, and I don't really anticipate that trend changing anytime soon. So someone in retirement would have had a very bad time during these volatile and inflationary periods, which is why you should diversify. But someone who is younger can survive and thrive over the long term. So as always, guys, save part of every paycheck and invest it, and you'll be safe in the future. Thank you.